Let's kick things off for today, and welcome everybody to the final webinar for 2021 for myself. And it's been a big year of delivering materials. I really hope that 2022 gives me the opportunity to get back out there face to face. I did have the chance through a couple of my workshops during the year, earlier in the year, and then one late, but it'll be really nice to hit the road again. So, fingers crossed that's where 2022 will take us. So I thought, whilst winding up the year, a good subject matter to finish the year would be wind-ups and self-managed superannuation funds. So I want to address this from the strategic point of view, and then also, I guess, the practical side of things, just to get an appreciation for what we go through with winding up self-managed superannuation funds. So, as always, if you've got any questions, chuck them into the Q&A box, and I will endeavour to answer them as we go along, and we'll hopefully leave a little bit of time at the end for any further questions. I've also done a number of presentations on webinars in the past, and so I have built up a fair few sort of frequently asked questions around this space. And I was digging around trying to find the document before I started today, but hopefully I can dig that one up and can send it through with the copy of the slides after the presentation. So what am I expecting you all to be able to get out of this today is, I guess, really the key issues of the reasons why self-managed super fund might be wound up, but also then the alternatives to winding up a fund. So what options do we have available to us as opposed to winding it up? The must-do processes. So ultimately, really going through a bit of a practical checklist of SMSF wind-ups and working out what processes must be done before we can go through the final step, and then our reporting and record-keeping obligations. So, I find this to be one of those subject matters that I talk about every couple of years, and it's a good refresher topic, because it's one of those things that in SMSF practices, you may not actually wind up a fund every year or every 2 years. And so, when you have to come around to going through the process, it's good to get that refresher on it and get a bit of an idea as to what you need to undertake. Because ultimately what will happen in a lot of situations is the trustees will say, I want to wind up my fund. And they think that there is sort of some immediacy to the process. And sort of they put the pressure on to make sure it happens relatively quickly. But ultimately, they're going to control a lot of the steps around asset sales and other things. And so often the process will take as long as the trustees themselves take to undertake the necessary steps involved. So let's work through this from I guess a regulatory point of view, and also from a position of identifying the key issues that we need to talk through with trustees when the question about winding a self-managed super fund itself comes up. So, the whole concept of whether an SMSF is the right fit. And, it's fair to say, having been in practice or in administration space for 20 odd years, it's fair to say that there's a lot of self-managed super funds out there that probably shouldn't be self-managed super funds. We probably all know a few clients in that situation, and so it's often important to work through some of the key points about what's suitable in the SMSF space. And so if we look at the SMSF suitability, the tax office, I think they provide a good resource in many respects around a lot of the areas of self-managed superannuation funds. Fair to say that they're not always practically on point with their examples that they provide in a lot of their online material, in that they give some great guidance, but then they often will give examples that are perhaps sort of not the norm, and so it doesn't help us work our way through all of the simpler processes in the space. So it's not always the best guide for trustees, but historically they have had some really good material on SMSF windups. And one of the things that I've effectively taken from that ATO material over the time is this effectively these questions that the ATO ask or have historically asked of trustees with regards to whether they've got the capacity to have that ongoing responsibility of being a self-managed super fund trustee. So they'll look at such things as, do they have a good knowledge of their responsibilities and obligation? Now, this is a loaded question in many ways, because since 2007, they've all signed a declaration that suggests that they do. Now, we all know that a lot of trustees will take that step of setting up a fund, and they'll sign their trustee declaration. But how far through the actual process of understanding their responsibilities have they gone is a separate issue. And often you'll find that one member in a self-managed super fund has done a lot of research and does a lot of the I guess the hack work, for want of a better term, and then the other trustee or trustees are often quite passive in their approach to their responsibilities. Now, that can be problematic, particularly in the situation where it's the more active trustee that potentially passes away or wishes to leave a fund, or is forced to leave a fund for other purposes. Then those other passive trustees, what responsibilities do they not know that they need to undertake moving forward? Following on from that, whether they've got the time to run the self-managed super fund. I always find this a bit of an odd one, because running my own fund, I do accept that I have a reasonable knowledge of self-managed super funds, but the concept of running your own superannuation fund, I don't necessarily think it is a time draining situation or event. I think if you, particularly if you're outsourcing the administration, if you do your own administration and you regularly review your investment strategy on a weekly, monthly, whatever basis it might be, then potentially there is a fair amount of time put into it on an ongoing basis. But arguably, even if you are just doing a review of your strategy once a month, once a quarter, whatever it might be, and then collating information to prepare the financial statements, then it's not and shouldn't be a huge time drain on any SMSF trustees. Are the SMSF running costs more than they want to pay, or would another super fund cost less? So that's always subjective. How much do people want to pay? There's a very short answer to that, and that's nothing is the preferred price. And so if we work our way up from nothing to the top fee that's charged, most funds will sit somewhere within that category, and ultimately, you often find in the SMSF space that you get what you pay for. So we know that there are a lot of service providers out there now that provide like full-blown services, and that comes at a cost. And then there are others that provide far less service. You potentially don't have dedicated client managers as such and things, and then you effectively pay for that. You pay less because you're getting less support, and so a lot of it comes down to where do you sit in that cost basis. And again, this is an area that I think the ATO have done exceptionally well in starting to break down the cost associated with running funds. And if you look at your standard funds and standard administration, those costs really aren't that high in the averaging sense overall from an assets point of view. And so really it's about choice, and it's about service provision choices and those things as well. Are you able to continue monitoring the fund's investments effectively, or do you get higher returns if the fund was managed in another type of fund? That's a piece of string question, because as we see with the global financial crisis of 2008, we see it a little bit with the start of the COVID-19 pandemic. When the markets start to dip to any sort of reasonable degree, then we always see, and I think inappropriately, but we always see a bit of a spike in SMSF establishment, because people get frustrated with how their fund's performing and they feel that they can perform better. Now, in some instances, if they want to put in a huge amount of time, like a lot of the fund managers would be doing, analysing the markets, then arguably they can do better. What they get when they move from a non-SMSF to an SMSF is control over the investments. But they're investing in the same market ultimately. So really, it's one of those things where we need to have a balanced conversation about an us versus them approach to fund investments, and say it's more about investment choice and investment timing than being able to outperform the market or the managed funds as such. So I think that's one of always those subjective issues, and I think all of these issues to some degree are subjective. Do they still want the responsibility of running the fund? of course, that's ultimately going to be the one that decides the position for them, and having that ultimate responsibility. And do they all still agree how to manage the fund? And I guess this is the classic one. As relationships break down, as families break up, all sorts of things occur, and potentially you get to this crossroad where people aren't talking, or whatever the situation might be, and it makes it very difficult to run a self-managed super fund in those situations. So, the reasons that we see for winding up funds is that all the members and trustees have left the fund, that all the benefits have been paid out of the fund, that it no longer meets the needs of the clients. They don't have the time, skill, or knowledge to manage it. It's not cost effective. The members decide to relocate overseas, and I'm going to go through some of these reasons and sort of highlight not just the alternatives, in a sort of summative kind of way, but a little bit more detail as well, particularly ones like overseas relocation, and what the federal budget and a looming election might actually mean to self-managed super funds that are operated with the trustees being overseas. A relationship between the fund members breaks down, and this is a classic one. Is an SMSF right for a couple? And when we talk about a balance in old school terms of $200,000 as kind of being that original concept of a starting point for self-managed funds. Well, if that was made up of two members with 100,000 each, then they separate and go their own ways. Well, is $100,000 right or wrong? And this is where it comes back to the service provision side of things and the cost effectiveness. So there are probably service providers out there where that sort of level is still appropriate. And so there might still be the capacity for a self-managed fund to be continued on when relationships break down and funds are split up. So all of these sorts of things come into the decision-making process. If the trustees are disqualified or incorporating bankruptcy, so clearly there's an issue there where that person cannot be the trustee of a self-managed superannuation fund, and so they'll have to act under those circumstances. And then the other time is when the ATO directs the trustees to wind up the fund. Now, of course, when we say when must a super fund be wound up, basically when the ATO tell you to. So under all other circumstances, because we're dealing with an indefinitely continuing fund, the structure can remain in place even if we're adding, removing members and doing other things. But if the ATO direct you to wind up the fund, then that's when the fund must be wound up. Now, again, this is speaking purely from a personal experience, but I've never come across, and maybe that's because I've worked in the pure admin space, but I've never come across a fund whose compliance issues have been so terrible that the ATO have given a direction to wind the fund up. I know it's existed. I've heard others talk about it, but it's not something that happens on a common basis. So it's one of those situations where most decisions to wind up are going to be based on a decision of the trustees or those supporting the trustees to make those decisions. So if we look at the alternatives and whether there are options as such, well, then the obvious one is if we've got a member who leaves a fund, well, one, we can either keep the fund going as it is, or we can add other members. Now, given that we now have the capacity to have 6-member self-managed superannuation funds, this adds weight to the concept of bringing people in as they hit that employment age, and they talk about stapled superannuation, and potentially, I think someone would be sort of not really contemplating stapled superannuation if they're just starting out. They wouldn't be contemplating a self-managed super fund. But if they've got a family self-managed superannuation fund, and the fund is of a reasonable size and it's got a fairly solid investment strategy and is generating some reasonable returns, then what's not to suggest that it isn't the right time then to potentially bring the children in and staple the self-managed super fund to the child. That sounds a bit awkward, but in the sense of having employers being able to contribute to that fund. Same thing with benefits being paid out. Once the retiring members, let's say the parents of a fund look to leave, then there's nothing to suggest that's not the time to potentially bring the new members and bring the kids. And often that might be the best time. Because the parents and the children, who might have a different investment dynamic, won't be then making decisions about the fund at the same time, and it's more that intergenerational structure where we're just keeping the shell in place, and potentially the corporate trustee, where we've got appointments and removals of directors and other things along the way. So, using the shell of the SMSF as an ongoing family investment vehicle for retirement purposes no longer meets the needs. Again, these are all the same sort of concept, but if other family members potentially have those needs, then maybe there is a purpose to keep the fund open. Insufficient time, skill, or knowledge. Well, that's where I guess people like myself come on board, but certainly not just myself, but all of you as well as SMSF professionals. Providing greater education. I've certainly found that in my time doing SMSF education in both the SMSF professional and the SMSF trustee space, when you get a group of SMSF trustees in the room, and everyone says, look, just make the presentation 45 minutes because attention spans and all those sorts of things. Well, the reality of every session I've ever delivered to trustees is the questions could just go on and on and on and on, because they're like a sponge. They just want to soak up the as much information as possible. And so I think it's incumbent on all of us to be providing more material and more support to SMSF trustees to get them engaged or more engaged in the vehicle that they have invested in. But of course, if they don't have those skills and maybe can't grasp the skills and don't have the knowledge to undertake their responsibility as trustee, then there is the small APRA option, albeit that it's a small option. And I'm going to talk a little bit more around small APRA, as I work through a couple of the key issues around, say, bankruptcy and overseas travel and things like that. But what small APRA does provide is it provides a well and truly under-regulated, and I shouldn't say under-regulated because small APRA is over-regulated, but it's an under-supported opportunity within our industry. And people like myself have probably banged on about small APRA funds far too much, or maybe not enough, because we're in a space where self-managed super funds is such a large part of our industry and small APRA funds is such a small part. Whereas I suspect the balance between the two should at least be, the gap should narrow, because there's a lot of people in self-managed super funds that probably would be better off with a professional trustee managing their actual investments and their responsibilities. But that's for another time and day and time. But I certainly still think that there's great merit in the small APRA structure as such. Again, things like the cost effectiveness, so you can look at our alternative service providers and move away. If we talk about things like relocating overseas and disqualification, then both of them have the option of having the small APRA trustee act as trustee of the fund. But of course, if we've got relocating overseas, then you've also got the central management issue where you can appoint an alternate trustee, so you can look at that enduring power of attorney model. Look, again, it's one of those areas that I'm all for supporting trustees working through that process of appointing an enduring power of attorney, but that enduring power of attorney really does have to understand that they're taking on the full throttle approach to trusteeship, and they're not just acting under an attorney, they're actually taking over that position. And so, you've then got someone who, albeit may not be a family member, maybe somebody else, acting on your behalf. And so then you've got to look and say, okay, well, we're better off getting a professional to do this, or we're better off getting somebody else who maybe, we're talking through the phone to and telling them what to do, which then suggests, well, are they actually acting as trustee of the fund? So it's one of those, difficult scenarios to put ourselves in that hopefully government changes help us in this space. And so then the only one really without any significant answer other than to do what you're told is if the ATO give a direction to wind up the fund. So what are some of the flags that I see and we all would have seen in the process of winding up self-managed superannuation funds? Well, the first one is timing. Timing, which covers off on a lot of the issues associated with the wind-up process, is generally the biggest problem that we encounter, because people sort of get this picture in their mind of wanting to wind up a fund, and they want to wind it up now, but they haven't actually taken any action to start the wind-up process, and inevitably they've got assets Often they'll have illiquid assets where it's going to take time to redeem those assets and then get the proceeds in to then start the actual wind up process. So to me, it's one of those issues from a timing point of view that when somebody says to me, if they come to us and in June and say, I'd like to wind my fund up at 30 June, the immediate answer is, oh, excellent, you're giving us 13 months to get the fund wound up, because it's unlikely that they would have already sold all their assets and be sitting there just in cash to be able to pay everything out within the ensuing 30 days or whatever it might be, or week or so if they give you that amount of time to do the wind up. So timing is one of those critical areas where we have to make sure that the trustees understand that if they don't follow a due process of selling down the assets in a timely manner and then rolling over and doing the actual benefit payments pre the date of the wind up, then the fund is effectively moved into another financial year if that date is 30th of June, and you've got to go through all that process again. So you've got one more year of lodgement and other things to be mindful of. And you can see trustees getting a little bit shirty about that sort of stuff, but ultimately it all comes back to that education piece, the communication piece, that they know that this process takes time, and in some instances that time could extend by a number of months. It could extend into new financial years. It could extend over a couple of years if they've got certain assets that they're trying to liquidate, and it's a difficult market to liquidate those particular assets in. So there are options, and we can talk about some of those options, but in essence, if they're in accumulation phase and they don't have liquidity outside of super, then those options may be very limiting for them. So timing number one. Relationships, what sort of relationship have you got between the trustees as to be able to work through the process? I remember one that took a couple of years to do, because we received a letter from one of the members trustees saying, I resign immediately, or effective immediately from my position, and I want to roll over my benefits and wind up the fund, but hadn't had the conversation with in this instance it was a sibling and the sibling's spouse, and so the fund then sort of motored on for a lot longer that was intended, because they hadn't had that conversation up front. So I guess a lot of these flags are really just that. They're just sort of identifying some of the key issues associated with the concept of winding up funds that we really need to be able to tick off and say, have you thought about all of these issues? So realized unrealized capital losses. Every time that we have a financial crisis, and I'll go through a couple of examples, or an example about this a little bit later, but if we realize these losses and they're sitting in the fund, well, then how beneficial are they going to be in the future to other members? It's like the whole pension segregation and those sorts of issues, and the transfer balance cap has taken care of a lot of this to a degree, but the whole idea of previously moving from accumulation to pension and then not being considerate of the CGT implications because of exempt current pension income, whereas the whole thought process around, well, if we've actually got accumulating members and we've got other assets that are subject to gains, will we benefit from potentially realising and maintaining these losses moving forward? So that's one side of the equation, but then the other side is obviously capital gains, and selling down assets in a high sort of gain market inevitably leads to a higher tax liability. So having that conversation is a key point. Carried forward tax losses, look, not as significant an issue, but certainly when we talk about intergenerational, when we talk about death benefits and the requirement to have insurance inside of super, I think there is always this thought process, and particularly because those of you that know me well will know that I'll often talk about the future liability to pay a benefit deduction, which is linked to insurance with death and TPD and benefits that are paid pre-65. Well, those sorts of insurance-based deductions can create tax losses in the fund, and you want to make sure that you can utilise those tax losses and offset potentially the tax on contributions and other things for accumulating members. So you never want to put yourself in a situation where funds are to the point where they're not making the best out of the situation that they've got from a taxation or a membership point of view. Of course, you also don't want to mitigate issues, so you don't want to have scenarios where you've got not unruly but trustees who can't work with each other. You don't want to say, well, hang on, let's just keep this fund running for another couple of years because we've got a few dollars of capital losses. You're not going to go down that path. But certainly, you know, in the initial conversation piece, it's always worth raising these particular issues. And the concept of delisted shares, frozen funds, and property assets. Really, what I'm talking about there is the illiquid nature of certain investments. And when you've got shares, you've got companies that are going through the process of being wound up and removed from the ASX or whatever. You know, that concept of, do we wait for the ATO to say it's okay to realise this as a nil sale, and therefore recognise the loss within the fund? Up until that point, are we in a situation where we have to transfer the asset? If we're doing that, what's the value that we're going to transfer that asset as? Same thing happens with our managed funds. If they're frozen, inevitably you can't act on those frozen funds. So, you know, do you go through the process of documenting a transfer of them at an assumed value just to get them out of the fund? And I've seen that occur, and it's one of the things that has to be contemplated in the process. And of course, property, just being a larger asset, does require some time often to sell. And then really the compliant pension one, look, less and less of us need to worry about this, and we'll wait and see what happens with legacy pensions and if there is any amnesty moving forward. But clearly, if you've got someone that has a compliant pension in the fund, they can't just wind up their fund and take their benefits out. There are ramifications from that, which is then the final issue of, if you're rolling over or winding up in pension phase versus accumulation phase. It's that whole concept of having to prepare rollovers versus doing benefit payments. You know, not just, it's my money, I'm going to take it now. So these are all the key issues that people need to be mindful of, and the flags, I guess, that form part of the inevitable wind up checklist. To say, have we considered all of these things? Are any of these things relevant to our fund before we make the decision? And then once we make the decision, go through the actual process of winding up the self-managed super fund as such. So again, some of those reasons to highlight them of why we would consider retaining the fund. Taxation, I certainly, whilst it's probably not the most clear-cut or adventurous sort of scenario to be discussing with trustees, I think it's a real critical point. And no more real examples than what I've seen. And you know, I didn't put the COVID-19 situation because I didn't feel that was as significant as an event from a market point of view as, say, the 2002 dot-com bubble and the 2008 global financial crisis. So for both of those, we had, you know, extended periods of market decline, and you know, it was relatively troubling from a well, not just SMSF point of view, but particularly when you were monitoring and looking at your own investments as you went along. The taxation implications of these transactions were fairly significant. So, you know, what I saw back then, and these examples, you know, I first saw them in the 2002 one, when all of the tech stock sort of crashed fairly significantly. You saw these drops, and look, in some instances I'm being conservative there, but if we say on average that we saw a lot of funds dropping from between 20 and 40% overnight, you know, you saw that the significant losses that people were undertaking or having on board. But the issue that often would come about, and it's a difficult conversation to have sometimes with trustees, but I remember, I think this was more in the global financial crisis, where I had one trustee ring me and said, like, what do I do, Tim? Now, granted that I can't give financial advice and don't give financial advice. So what do I do, Tim? I lost a few $100,000 last night. And so, and I didn't answer it directly this way, but I said, well, why did you sell the assets? And they said, well, we didn't sell the assets. I said, well, not trying to sort of be flippant about this, but you haven't lost anything yet. I said, you've had a paper loss, but you haven't had a real loss. And so, you know, the timing is everything in these sorts of situations. And so when you do have losses, obviously there is a benefit in reviewing them to see if there's any gains you can potentially offset. But what I did see a lot of was where advisors, because of the market and the pressure that was being put on them by their clients, they took the decision to wind up funds during that time frame. And if you particularly consider the dot-com bubble, which was really in the infancy of self-managed superannuation funds, so these funds hadn't been really operating for a long enough period of time to experience high growth. And so we saw situations where funds that had like $300,000 worth of capital losses were being wound up, for those losses to never be able to be utilized by the fund. So to me, that wasn't necessarily, now there could have been more to that situation or to those situations, but to me, that's got to be one of the things that's addressed with the trustees is what are the taxation ramifications of this decision? What can you potentially recoup by staying in the fund a little bit longer? Now, the answer to that is that the next 5 years, from 2002 through to 2007, saw some of the most significant growth, which has ultimately led to a lot of the issues associated with compliant pension these days and the build-up of the reserves. Was the growth over that next 5 years was hugely significant. And of course, that's where we saw another influx of self-managed super funds, a whole lot of advisors coming in that only knew about growth because they hadn't experienced 2002, and then 2008 hit. So, that whole decision around taxation is a fairly critical one to at least converse with our clients about, with regards to what are the ramifications of winding up the fund at this point in time. Of course, another reason for retention goes back to all the family issues, as I said before, which is that it is an indefinitely continuing fund. So it doesn't have the lifespan of a normal trust. We can continue it on. If we've got a corporate trustee, then it leads into the intergenerational nature of it. Again, that's a separate issue to the idea of retaining assets and existing assets in the fund, because we've still got death benefit processes that we need to act on and be mindful of. So we can't just keep an asset in the fund because a member's died and there's new members there. We can't do the lump sum recontribution strategy through journaling documents. I know that I've probably in previous presentations referred to those as the good old days. But the reality is you never really were able to do that from parents to children as such. You would often do that from a spouse recontribution kind of process. So it was one of those areas where you made the best of a situation, but very early on in the 2000s, the ATO put a stop to the whole idea of recontribution strategies and things without actually physically taking assets or cash out of the fund. And so it's a pretty common standard now approach that yes, you can do in specie benefit payments or you can do cash payments, but you cannot journalize these sorts of entries. So intergenerational fund management is certainly a significant issue, which of course the three of those things, indefinitely continuing fund, intergenerational, and then business real property, they can go together if the fund is planned out appropriately. So if you've got the younger family members who are potentially in business with their parents joining the fund, and they are making large cash contributions to the fund, so whilst the parents' accounts are diminishing through the payment of pensions, and the child's account or the children's accounts are increasing through contributions, then there is the capacity to do a like for like swap, because the assets are the assets of the fund, and the cash from the contributions that's coming in can aid in the paying out of death benefits or lump sum withdrawals, whilst the property is being retained or in the side of the younger members of the fund. So a lot of those sorts of issues work nicely into the whole conversation piece about whether to wind up a fund or not. And of course, any other one is actually seeking appropriate professional support. So, a lot of people, if it's all too hard, maybe it's just that they haven't found the right people to help them out yet. And I think that's a key issue with regards to winding up funds is that whole relationship piece that people engage in. And, you go back to that example that I saw back in the early 2000s after the dot-com bubble burst, that advisor that wound up the funds, he was sort of advisor that potentially if those clients had have been with a different advisor, then the conversation would have been along the lines of, okay, well, this is a situation right now. If you want to wind up your fund, you can. However, let's have a look at what we can wait and see if there's a recovery and you get your money back there, or we can make the decision now. But if you make the decision now, you're going to cop these losses inside the superannuation environment. So it's really how you actually communicate that piece to the clients. So the other thing that we need to think about from winding up point of view is where we're at in the SMSF life cycle and what that means from a processing point of view and an action point of view. So what action can the trustees take at certain stages of the life cycle? So accumulation. Clearly, the first thing there is that members' benefits must be rolled over. So we've got to roll benefits over to another complying superannuation fund. The sale of those assets is going to be subject to CGT, regardless of whether we're actually selling down in the fund or whether we're doing an in-specie transfer. I had a question just the other day about doing a part in-specie transfer, part sale for a rollover. Now, I said in practice, that transaction can work, but what we've got to understand is that we're now operating in a superstream environment, and so there's this electronic transfer of information from an SMSF to the APRA fund or potentially to another self-managed superannuation fund, and then there's the actual practicalities behind it. And if you're just I want to say writing a check, that's a little bit old school as well, but if you're just doing an EFT of the funds, then you've got relatively quick process between the superstream material going across and the money going across. If you're doing in-specie transfers, then you've got to contemplate the filling in of forms, the completion of the forms, the seller signing it and the buyer signing it. Will the new fund accept in-specie transfers? What dates will they record? What's the cost base? All those sorts of things come into the decision-making process. But let's not forget, behind it all, there's a CGT obligation for the fund where the assets are leaving, unless the wind-up is because of a relationship breakdown and you've got the exception to transfer the assets to another fund subject to the asset split. So all of these things become fairly relevant. And then you've got other roadblocks that might exist in the accumulation phase. You've got UK transfers. So now this roadblock actually will occur in pension funds as well, because given that the UK aren't transferring money across until somebody has hit age 55, but given that our preservation age is we've got some 58-year-olds, 59-year-olds, and we're getting closer to 60-year-olds being the trigger for preservation and accessing superannuation. So you've potentially got that 5-year gap between money coming over from the UK and then money going into a pension here in Australia. But and then you've got the reporting back to the UK, and you've got this 10-year reporting period. So if you're looking to wind up a self-managed super fund that has brought money in from the UK, what ongoing reporting obligations have you got, or what rollover obligations have you got? Does it need to go to another qualified, recognised overseas pension scheme, whatever the terminology is now? So you need to make sure that you're not imposing, again, international tax penalties on people by undertaking action of having this SMSF is all too hard. We want to move our money out. Well, the reality is that in almost 99% of the cases, and probably push that up to 99.9%, you can only roll it from one SMSF to another SMSF if it's going to be a purely a cure-op situation. So that's definitely one to be mindful of. And then the other one, going back to the relationship breakdown thing, is the payment flag issue. So if anyone puts a payment flag as opposed to a payment split, then you can't pay benefits out of that fund until the flag is ultimately lifted. Now, that is uncommon for self-managed superannuation funds, but it certainly can exist. I have seen it exist from the point of view of paying benefits out. So if we move from accumulation to pension, then obviously you've got the key issues like transition to retirement is still actually in accumulation, albeit that it's an income stream. So if they haven't met another condition of release, they'd have to roll it over to another fund. And that in many respects, what that actually does, particularly from an estate planning point of view, and I know I'll make this point a little bit later as well, but if you've undertaken pension commencements to split tax-free and taxable benefits up for estate planning purposes, and you're moving that money from a self-managed super fund to an APRA fund, and you roll over these 5 different pensions or even these 2 pensions, and they hit that APRA fund at the same time, then all your tax-free and taxable planning goes out the window, and your one accumulation interest is merged, and ultimately all of your tax-free and that goes back into the same pool. So you've got those sorts of things to contemplate if you've done a lot of estate planning with your clients who then make the decision to wind up the fund. You've then got your complying pension issues, and I saw an interesting piece from Mercurium, I think it was earlier this week or last week, about the lack of providers now for lifetime and fixed term pensions, and that there's only very few market linked pension providers out there in the marketplace. So ultimately, the whole capacity for us to potentially wind these things up under some form of amnesty is reaching sort of this critical point where the option will be that if there's no retail offers out there, you can't roll them anywhere else. Now with market linked pensions, if you don't use the amnesty, that's going to be fine because it's an account-based pension. But if you've got these lifetime pensions, particularly given that most fixed terms have ceased now, then, you know, if they've got solvency issue, then that's going to have ongoing issues for the fund if there is nowhere else to roll over commence to. Yes, you've got your market link pension that you can roll to in the self-managed fund, but clearly if your objective is to wind it up, then you're going to be in this real sort of flux as to what you can actually do. And that may have Centrelink implications, as will rolling over an account-based pension will have Centrelink implications too, because if you had a pre-January 2015 account-based pension and you move it over to a new provider, then you move from the deductible amounts process to the deeming process. And whilst that can be pretty positive in the current deeming environment, if deeming rates go up because interest rates go up, then the account balance will be deemed at a greater amount, and that can potentially create future problems for clients. So, you know, these are all the additional issues that people need to be mindful of. And look, one of the questions that I get a lot or asked a lot is the whole concept of transferring assets, and again, going back to that in specie, transferring them if you've got a pension in place. And, you know, for me, the CGT liability has always been one of those quirky elements that if you had segregated assets and you stopped and went back to accumulation and then sold the assets, which is what the in specie transfer would do, then you're up for full tote odds on CGT, versus if you didn't have segregated assets and you applied the proportionate approach, then you can say, okay, well, it's only 1/365th or whatever the number of days is, and you're going to end up with a better CGT result. Now, of course, again, we're still waiting on more legislation to be passed in those choice issues around the exempt current pension income and actuarial certificates. But all of these things have consequences. Obviously, they all have transfer balance account reporting obligations as well, and that can be critical in that if you roll over your pension from your self-managed fund to an APRA fund, and the APRA fund reports within a couple of days commencing the pension, and the self-managed super fund goes along its merry way thinking it's an annual reporter, and so the administrator doesn't report until the lodgement of the final return, then you can find yourself in excess transfer balance account position, and that's not ideal for anyone. So a lot of different issues to be mindful of there. What I wanted to, before going into the processing and the actual sort of checklist as to how to operate, I sort of wanted to touch on a couple of the more sort of unique situations, because obviously everybody goes through accumulation and pension, but then where do we sit with things like bankruptcy and overseas living? So the bankruptcy one's an interesting one, particularly, and I mean, disqualified persons are the same, but the bankruptcy, because it has a time frame linked to it. But if you've got somebody from a bankruptcy point of view, they've got to resign immediately as trustee of the fund. So that's the first step. Now, clearly, often their membership doesn't follow them straight out the door as trustee. So there's that time frame, and you've got that 6-month window effectively of getting them out to make sure that the fund meets its definition appropriately, again, of having trusteeship and membership aligned. Now, the alternative to that is, because our legal personal representative cannot be placed on in our place if we are bankrupt or disqualified, then we can actually apply to have a small APRA trustee appointed to the fund in that situation. But the key issue is that we don't have to wind up a fund if the members have gone bankrupt, in that we can retain the assets from a CGT point of view. We can obviously retain pensions and all those other sorts of things for the point of view of being able to maintain the estate planning work and other things that are attributable to the fund. So in some instances, winding up is not going to be the right option to take. And so we look at the small APRA as a viable option under the terms of bankruptcy. The issue with the small APRA appointment is that there is ultimately, from my research, from my last research, and things can always change, I appreciate that, but there's ultimately two small APRA trustees that people can utilise. And from the last time I checked, really only one of them was actually promoting themselves as a small APRA trustee to new marketplace. So that really is an imbalance in potentially the desire and use and need for small APRA funds and their availability. And that to me is problematic, because I actually think they will solve a lot of problems for a lot of people around elder abuse and all these other issues that are sort of being highlighted more and more in the SMSF space, where if we're starting to address enduring powers of attorney versus alternate trustees, then the small APRA fund is clearly a strong way to look. The issue being that they've got the reporting obligations of an APRA fund, and so it makes it fairly undesirable for any approved trustee to want to actually take on the responsibility of quarterly or whatever the reporting requirements are of thousands of funds versus one or two funds. So it's not necessarily a desirable space from a trustee point of view because of their regulatory requirements. Whereas I think it is a desirable space for a lot of trustees to potentially move into that area. And it can actually be quite cost effective. So again, when I did my research into small APRA funds, I felt that the admin cost, or the cost of the trustee fee as such for small APRA was relatively cost effective, sort of over and above that $500,000 mark. Now that research was probably done 12 months or so ago, and so it probably needs to be adjusted slightly. But there was a point, particularly if you've got a lot of property in your fund, there's got to be a willingness for them to take on that transaction or that asset from a small APRA point of view. But if you've got those bulky assets, then the fee may very well be worth the process. So it is a consideration. Of course, if you go down that path, then once you're discharged from the bankruptcy, then you can become the trustee of the fund again. And then that leads us to the winding up for a non-residency point of view. So as we know, as it currently sits, we've got really our three tests. So forget the establishment test for the purposes of this, and we look at the central management and control and the active member test. So there's solutions to both of those things. Active member test is don't contribute whilst you're overseas unless you've got a contributor in Australia with more money who's also contributing. So, so it puts a real restriction on the contribution side of thing. And then you've got the central management and control, which we can work upon by having enduring powers of attorney. We could potentially look at small APRA as an option as well. But again, you want to look at the taxation side of things. And so there was a great inequity with the way that the definition of Australian super fund worked, because it was disproportionately unfavourable to self-managed super funds because of the control test being back to one or two people and the active member test being linked to one or two people. So it really was disproportionately unfair. And finally, the government listened, and it's a conversation that's been happening since I've been in the industry. But the government listened, and we saw in the budget this year, effectively the announcement to remove the active member test from 1 July 2022, which would mean you'd be able to contribute when you're overseas, and extend the definition of ordinarily so that our absence could be for up to 5 years if we are not permanently moving away. So if we're ordinarily in Australia, but we're away for a period of up to 5 years, then the central management and control could remain in Australia. So both of those are really positive measures, right? And go a long way towards fixing the non-residency issue with self-managed super funds. Of course, the caveat was that the introduction date would be 1 July 2022. Now, we have not seen any legislation on this yet, and we all know that we're heading to a federal election. So what we don't know is the likelihood of this measure being introduced and passed before the election. I would say that's very unlikely. I'd say don't quote me on this, but you can quote me on that. And B, whether if the election is won by the opposition, what appetite they have for these measures. And that's the great uncertainty with a lot of the budget announcements from this year, is what is the appetite to retain these measures, same with the legacy pension stuff, beyond a change in government. So, we have to ultimately keep our fingers crossed, our collective fingers crossed, that those measures, both legacy pension, albeit that we want to see that changed a little bit, but most definitely this residency one, which is one of the in my opinion, one of the best measures that's been introduced by any government over the last decade or so. That to me is critical, that we see that move regardless of the shape and form of our government. So fingers crossed that we get to keep that, and that it sort of almost takes the non-residency issue off the table when we're contemplating winding up funds. So we get to the point where we say, okay, well, we want to wind up the fund. What do we need to do? What is the process that we want to undertake to wind that fund up? So the first one is to check the deed for any wind up instructions. Now that might seem a little bit obvious from a statement point of view, but I remember some of the very first deeds from the late 90s that I saw. And they had some really weird references about winding up funds, and there was all sorts of links to monarchies and the death of the Queen and all sorts of stuff. And what there wasn't was just a simple instruction for trustees to be able to make a decision to wind up the fund. So, in the infancy of a lot of these deeds, they really didn't contemplate trustee responsibilities and processes as well as they do now. So whilst I say check the deed as point one, it's more a historical, I checked some really old ones and they were not very good in this space. And so just make sure your current funds are providing for the capacity for the trustees to make that decision. Then obviously you want all trustees to agree about the wind up and document their decision. So you really want to make sure that the documents, the decision is documented. You've got the minutes to show that all parties have agreed to it. And I know that we get in this situation now where there's a lot more disputes in the SMSF space, and so there's a lot more. Not a requirement to go to the lawyers, but there's a lot more involvement with various legal practitioners in this space. And I've heard a lot more through some of the presentations that they deliver about how to deal with rogue or sort of disenfranchised trustees who aren't willing to toe the line. And so, some of these situations are going to result in higher legal costs. And so, again, by having the conversation up front, maybe you can address some of those issues and do away with having to worry about the legal costs, because the legal costs are just going to diminish the members' balances. And it's all part of that conversation of, you want to get the best out. If you're going to make the decision to wind up your fund, you want to get the best out of it. And to get the best out of it, you need to maximise your members' balances. Determining the appropriate date, and as I said, timing is such a key issue to this. So consider the existing assets, how much time you need to sell them, what costs are associated with it all as well. So the appropriate date might be immediately if you're sitting in a cash environment and you can do rollovers relatively quickly, but it could be 6 months, it could be 12 months. And again, that decision comes down to the discussion point in the decision to agree that the trustees have undertaken. Then there's the member balance side of things, that we have to pay out or roll over the balance, which is going to be subject to the sale of the assets. Preparing that final audit for the final return to be lodged, indicating in that final return that the fund is being wound up. Pay any outstanding tax liabilities on debts if and as they arise, and then close the fund bank account. So this is kind of the checklist, which I'll sort of summarise again in a few minutes after going through a couple of the other steps. But yeah, ultimately the last thing we want to do in the wind up process is close the bank account. But in saying that, we also want to leave as little as possible in the bank account to do that final step. So we want to transfer out or pay out as large a portion of the members' balances as we possibly can, taking into consideration that final tax refund that might be potentially coming in, because and any bills that the fund might not have paid. But if you plan it properly, then you can pay that last audit fee, you can pay that last actuarial fee, the last lot of admin fees. All of that sort of stuff can be taken into account before the wind-up date if you plan appropriately and have those conversations early. So then the last thing really is the taxation refund. But again, if we've forgotten about assets, if managed funds and things are in the fund and we haven't sold them down, let's say before, I'm going to say before the end of the March quarter, but even earlier in the financial year, the better. We're then waiting on those final distributions to be received from the managed funds, and we're waiting on the tax reports and things as well. Now, inevitably, we're going to be waiting on the tax reports if we've got income received during the year for it. But again, it's a whole timing issue to make sure that we're not delaying the process as much as possible. Dealing with the other assets of the fund. So obviously you've got your listed securities in your property that you're either going to sell or you're going to potentially transfer in specie if you choose to do so, and the receiving fund will accept that. Or if there's a benefit payment, potentially get them valued market value to pay a benefit out to the members or the beneficiaries if it's a death benefit. But what if we've got frozen assets? What if we've got these managed funds and they haven't been able to be moved? Or what if we've got shares that were invested via, say, an employee share scheme or something, and there are restrictions on the transfer of these assets? Well, there's no definitive answer, unfortunately, for those sorts of situations. So it's making the best of a bad situation, and that is having that communication with the registry, with the various with the companies, with the fund managers or whatever, because it may very well be that you actually undertake the process of determining whether a valuation can be attributable to those assets. If there's no value and likely to be an asset, then probably is going to be a little bit easier to deal with. But if there is some value, can you at least prepare and do the off-market transfers, and do you have the capacity to acquire those investments from yourself, even if the actual ownership documentation can't be proven until a later point in time? Have you actually undertaken as much as possible to show that the super fund no longer owns it? You've got a declaration of trust on file, whatever it might be, to show that the fund has taken all the steps to remove that asset. And again, if you've got collectibles and personal use assets, then if you're selling them to yourselves, because ultimately that's probably the reason you had them in there in the first place, then have you got them independently valued by a qualified valuer? So all of those sorts of things that need to be taken into consideration in the normal world are escalated when it comes to winding up the fund. As I said, pay out the benefit or roll it over, so there are no assets left. Issue PAYG payment summaries. Of course, the payment summaries, it's a diminishing environment for us, because if now that preservation age hit 59 or hitting 59, less people will be requiring PAYG summaries, excluding obviously our complying pensioners with more than $100,000, but they're probably a different conversation to this. Issue the PAYG summary before we eventually, and withhold the tax before we eventually cancel that PAYG registration. And again, I can't emphasize enough about the paying it out versus rolling it over, and it's all subject to meeting conditions of release that people need to be mindful of. From an admin point of view, do that final audit of the fund, get your actuarial certificates needed, and then lodge the final return. That's where you notify the tax office, right? So yes, there are all the regulatory requirements, but that's where we do our notification of the fund being wound up. But it's also where we make our necessary adjustments for the supervisory levy. So if we're doing our final return, we basically need to have the adjustment amount in M at section D there, which means that we're not paying next year's return for next year's levy if it is our final year. So what happens from an ATO point of view is once we've acknowledged it, once we put it in the return that it's the final return, the ATO will confirm that funds met its reporting and tax responsibilities and send a letter stating that they've cancelled the fund's ABN and closed the SMSF record on their systems. As I said, don't close the bank account until after that point. That's probably the one practical point that I would make time and time again is make sure that you've got that final return lodge, all that sort of stuff done, and then cleaned out that bank account, not before. The other one probably is it's not an absolute requirement, but it's probably a requirement that most people will undertake. is winding up their corporate trustee. So if they don't intend to wind it up, it might have other responsibilities, or you may have a desire to give it further responsibilities, the company, in which case you may need to transfer it from being a special purpose company. But otherwise, you need to go through the process of doing the voluntary deregistration of it by paying any outstanding fees. You've got to apply to deregister it at least 2 weeks before the annual review fee due date. Otherwise, you carry over a year. I got caught up with that once myself for another company that I ran or owned, and so that caught me out by not doing it in time. I gave myself an extra year's worth of fees, which was a bit of a nuisance, but just be mindful of that. Then apply using the application for voluntary deregistration of a company, $42. All the members have got to agree to it, must not be conducting any business, got assets worth less than $1,000, no outstanding liabilities, no legal proceedings. So all the processes to go through from an ASIC point of view. So then that takes us just really to summarize all of those points for you. So clearly, from a checklist point of view, you want to make sure that all trustees have agreed to the process in writing. Check all the legislative requirements, the deed requirements, any other statutory requirements that you might actually have there. As I said, 30 June date is a preferable wind-up date from an ATO point of view, but that's really more about saying that all your transactions have occurred by that date. So ultimately, it's actually much better to have done it earlier in the year to give yourself time to do all of those lodgements. But with your assets, are you selling them? Are you transferring them? Have you taken consideration of the CGT liability, the costs, any outstanding income associated with those assets? Have you paid all expenses? Have you done all the adjustments to the member accounts? Then are the benefits being transferred, addressing any residual liabilities and payments? So again, if you've got that final tax return coming in, or tax refund, you've done your rollover statements or your benefit payments out, you're going to need to address the fact that there's a residual benefit to be paid and how that's actually going to be made. And are there any final distributions? Report the wind up to the ATO in the final return, prepare the final audit of the financial statements, incorporating that last actuarial certificate if there was ECPI to be claimed for the year, complete and lodge the return and pay the outstanding tax. Again, probably the thing where people tend to forget about, and I've certainly seen this in the admin space, is the cancellation of activity statements, the cancellation of PAYG, the cancellation of GST registration. It's really about confirming that all those sorts of things have occurred. So you would hope that the ATO would undertake the process, but often the ATO systems don't all talk to each other that well, and you'll still get PAYG documentation, or you might get some GST or questions about GST after the event. So really, it's a matter of making sure that you've crossed all the T's, dotted all the I's with regards to the various taxation obligations. Make sure that you've wound up the corporate trustee if that's the path you're going to go, and then the document retention side of things. So the last thing is to make sure that all of your minutes, trustee decisions are retained for 10 years. So it's not a matter of winding up and throwing out. Retain it for 10 years, and all of your financial statements and tax details need to be retained for 5 years. So there's a fair bit that goes through the wind up process, and really, to me, the key is always the issue of addressing it from a communication point up front with your clients about what their intentions are and how long the process can apply for. So look, that brings me to the end, and brings to the end of webinars for this year. Thanks for being on board. Look forward to releasing dates for next lot, first one for 2022. At this stage, I'm planning on talking about estate planning in the first webinar for the year. As always, if you've got any questions, shoot them through. You can always contact me after the event as well. The webinar will be available on demand. We're also updating our website to have all of the historical webinars there for viewing at your leisure or pleasure, should I say that about rewatching webinars, SMSF webinars. But yeah, having all of that material available to you. So thanks once again for joining me, and I look forward to catching up with you all in 2022.